Alright, we just finished going through the whole deck on optical communications and that little name MSS, ticker 6830, and we want to share what stood out. Here's the fear hanging over this whole space, the big co. Packaged optics dream keeps slipping, and when folks hear delay, they hit the sell button. But the deck reads it a different way. The demand didn't vanish, it just mutated and went looking for an easier door. And whoever ends up winning the road, somebody still has to sell the pickaxes. That's the whole thesis we want to unpack here. Here's how the deck frames it. On one side, the bear case, core packaged optics, CPO, getting delayed, the little clock ticking down. On the other side, the bull case, the deck calls it demand surging and routes mutating, two very different stories pulling on the same stock. Now think about it. You've got a fight over which technology road wins and when, and that kind of fight can chop a small name to pieces. But the deck plants MSS, ticker 6830, right in the dead center of that crossroads, deliberately not picking a side. And the line at the bottom is blunt. The deck says MSS focuses strictly on solving friction. That is the whole job. Our read, and this part is us talking. A company sitting in the middle doesn't have to guess the winner. It just needs the race to keep running. That's the pickaxe idea. You don't bet on one miner. You sell the tool that every single miner has to buy. So why is CPO getting pushed out? The deck lines up 3 hard reasons, and these are not soft excuses. First, the deck shows connection yield sitting around 95%, and in this game, 95% is not a win, it's a trap. Second, high failure risk on those large ASICs, and third, what the deck calls prohibitive downtime, a full motherboard return when one part breaks. Stack those 3 together, and you get the result printed right there. CPO delay, plain and simple. And here's the number that matters. The deck says the scale timeline slid from 2027 out to 2028 and 2029. 2 years gone, that's not a hiccup, that's a real shove down the road for the entire mass production story. But pay attention to the distinction the deck draws. It is questioning the timeline, not the long-term demand. Our take, a delay in when is a very different animal from a death of weather, and the market loves to confuse the two. Okay, so CPO got delayed. Does that mean the money just sat there and waited? No, the deck says it moved. Here's the picture. Capital and computing demand slams into the CPO delay, and instead of stopping, it splits off into other routes. The deck points to 3 of them. First, InP, indium phosphide, with Lumentum named and what the slide calls rising adoption. Second, VCSEL, where the deck draws a line from Broadcom straight to Google TPU demand. That's real compute pulling on it. Third, micro LED with Credo and Avicenna listed, plus that scale up, in idea for shoving data around inside the box. And the bottom line the deck lands on is the whole point. Demand has not vanished. It is mutating and speeding up. It's flowing toward the more mature near packaged optics routes, NPO, that easier door we mentioned right up top. Our RID, and this is the quiet part, a delay on one road can actually dump all that traffic onto the road right beside it. So both of these, CPO and NPO, are chasing the exact same goal, get the optics sitting closer to the silicon. The deck is clear on that. But they go about it differently. The deck says CPO is the highest integration, everything packed tight, the most elegant version of the dream. The catch, and the deck spells it out, immense engineering difficulty and mass production delay. That elegance comes at a brutal price. Then there's NPO, near packaged optics. The deck calls it lower integration, but easier to manufacture and ready earlier. See the trade? You give up a little tightness, and in return you get something you can actually build today. And the arrow in the middle is doing real work. The deck labels it accelerating transition, the money flowing the easier way. The synthesis line is the whole slide. The deck says CPO complexity forces capital and demand to accelerate NPO as the immediate stepping stone. Our read, when the perfect option keeps slipping, the good enough option that ships now starts eating the demand. That's just human nature on a factory floor. Here's the smartest slide in the deck. It splits the whole debate into 2 buckets, what nobody knows and what everybody knows. In the high uncertainty bucket, the deck puts the scaling route, CPO or NPO, and the timeline, is it year X, year Y, or year Z? Nobody has those answers nailed down. The deck is honest about that. The route is a question mark, and the calendar is a question mark. But then the high certainty bucket, and this is the anchor. The deck calls the optical interconnect transition a universal consensus. Translation: the industry argues about how and when, but almost nobody argues about whether light is replacing copper. Full stop. Now look at the takeaway picture. The bull and the bear sitting at the table, placing their chips on route and year. And the deck slaps a red X on the single bet. It says betting on one outcome equals high failure risk. Our read, in a fight with this many unknowns, the one who refuses to gamble on a single square is the one left standing. So if you don't bet on the route, what do you actually do? The deck says you sell to both roads at the same time. Here's the layout. The CPO route and the NPO route both feed into the same box. The deck labels it debug and failure analysis. Both paths run straight through that box before anything reaches market deployment. That's the choke point MSS wants to own. And the deck quotes the chairman directly. We are a yield debug assister, not a mass production equipment seller. That's the mandate. Read that twice. The company is telling you on the record what it is, and just as important, what it refuses to be. Then the deck lays out why this works. It calls it the inevitability. Connecting light to silicon always creates leakage, scattering, and loss. Integration creates friction, and friction requires debugging. That's the deck's logic, and it holds no matter which architecture ends up winning. Our read, this is the pickaxe in one sentence. You don't need to know which miner strikes gold if every miner has to clean their tools. Now this one's a little counterintuitive, so stay with me. The deck argues the very delay we've been worried about is good for one part of the business. Here's the chart, yield rates running flat along the bottom and service demand duration climbing up, and to the right, from early phase to extended phase. And the deck cites some analysis on the bottleneck. It says 95% yield traps the whole industry in the R&D phase longer. Walk the logic loop the deck draws. Step 1, low yield means a longer R&D phase. That part is just physics. Step 2, a longer R&D phase means extended demand for MSS debugging services. The slower the fix, the longer they get paid. Think about it. Every extra month stuck debugging is another month the meter is running on the service business. But the deck plays it straight with the catch. This bullish read only applies to the core service line. The same delays that feed the service meter, the deck says, push back the timeline for equipment and IP licensing revenue, so it genuinely cuts both ways. Okay, here's the real test for this whole thesis. If demand mutates over to MPO, can MSS actually follow it there? The deck starts with the good news. It shows the MSS CLAM patent coverage running from 100 nm all the way out to 6000 nm. That's a wide net. And inside it sit both the NP wavelengths and the VCSEL wavelengths. The slide marks them right on the band. Then the validation check. The deck runs NP, VCSEL, and micro LED all into that same CLAM patent, and they come back covered. The conclusion the deck draws? The patent encompasses the MPO light source wavelengths, so on the light side, the tools already reach. But here's where the deck gets honest. It flags a pending test, and this is the part that's still unproven. MPO comes with varied packaging structures, and the deck says MSS still has to prove its detection methods adapt to those new shapes. Our read, covering the wavelength is one thing. Proving you can inspect a brand new package is another. Watch that gap closely. So where does the actual money come from? The deck lays it out as a 4-box grid, present cash on one side, future catalysts on the other. Top left, the core that pays the bills today. The deck calls it analysis services and labels it active cash flow. That's the engine running right now. The debugging and failure work we've been talking about, money in the door this quarter. Top right, the future catalyst on the core. The deck names AI dedicated zones, with tier 1 client expansion sitting underneath. Bottom left, on the expansion side, overseas markets. The deck tags that one as a steady growth driver, not flashy but reliable. And bottom right, the big one, silicon photonics equipment and IP. The deck flat out calls it future mass production revenue. See the pattern? The left half is feeding the company today, so the right half is the bet on tomorrow, and the deck keeps them clearly separate. Our read, the present is the service meter we trust, and the future is the equipment and IP price, which still hangs on the timeline. Now let's talk about the actual machine. The deck puts it bluntly in the title. The MSS HG is an R&D instrument, not a factory line. Look at what the deck says it's built for. 4 jobs: R&D, engineering, validation, failure analysis, and low volume, high mix work. And the deck draws a hard line. It marks the tool as flexible and accurate for R&D, then slaps an X right over mass production. That's a choice, not a limitation. The company is saying we don't chase high throughput, we chase the tricky, one-off problems. Here's the timeline the deck gives, validated back in September, and then a commercial launch by year end with a little rocket on it. So the proof of concept box is checked, and the deck has the selling phase kicking off at the back end of the year. And check who's lined up to buy. The deck lists PIC fabs, AI chip designers, CPO packaging houses, and optical module makers. Our read, that's a broad customer mix across the whole supply chain. And notice it doesn't matter which route those buyers end up picking. Alright, this slide is the honest gut check of the whole story. The deck calls it a dual impact on revenue, and it's drawn as a seesaw. On the left, service revenue going up, the deck says extended debugging cycles drive that analysis demand higher and higher. On the right, equipment and IP revenue going down. The deck says the lack of mass production pushes those deployment timelines down and out. And what's the fulcrum, the thing balancing the whole board? The deck names it right there, delayed mass production. So the same single fact, the delay, lifts one side of the business while it presses the other side down at the exact same time. That's the dilemma in one picture. You can't fully cheer the delay, and you can't fully fear it either. And the deck closes with the core insight. It calls MSS neutral positioning a brilliant strategic shield. The company's framing and the decks read together. But here's the line that matters. The deck says the ultimate revenue is anchored to one thing MSS cannot control, the macro industry tempo. Now here's where it gets interesting for anybody watching the stock. The deck calls it the sentiment gap, fundamentals against market noise. Picture two lines. The deck draws a smooth blue one climbing steadily. That's the fundamental reality, what it calls the service anchor. Then a jagged orange line whipping all over the place. That's the stock sentiment. The deck labels it optical sector contagion. Here's the anchor the deck describes. MSS core service business is highly insulated from which technology wins the route debate. But here's the contagion. Despite that resilience, the deck says the stock trades in lockstep with the broader optical sector, rising on hype, crashing on bearish reports. The deck is blunt about it. The share price gets dragged around by the whole sector's mood. And the takeaway the deck lands on, the gap between that smooth fundamental line and the jagged sentiment line creates structural valuation opportunities. I'll read, when a steady business gets priced on the sector's panic, that disconnect itself is the thing a patient investor circles, but that's just our take. Okay, we've laid out the bull side, now let's be grown-ups about it. The deck puts 4 real risks up on a radar screen. Number 1, route uncertainty. The deck says the CPO versus NPO timeline consensus is still fractured, nobody's agreed on the path. Number 2, tech adaptability. And we flagged this one earlier, MSS has to keep proving its tools adapt to those novel MPO packaging structures. Number 3, realization lag. The deck says the equipment and IP revenue is heavily back, weighted because mass production keeps getting delayed. And number 4, sentiment contagion. The stock stays vulnerable to the macro optical sector swinging it around. The deck doesn't sugarcoat it. Now pay attention to the disclaimer at the bottom because it matters. The deck notes MSS is actively promoting IP licensing around its CLAM patents, and it states there is relevant IP litigation currently ongoing. The deck stays strictly neutral and assigns no outcome to those proceedings. We'll do the exact same here. We're not calling a winner in any courtroom. We're just flagging it as a live item on the board. Here's the part that separates a glance from real thinking. The deck calls it second level thinking, the price of selling pickaxes. It draws a balanced scale, positioning safety on one side, timing passivity on the other, and you've got to weigh both. The synthesis is the bull case in plain English. The deck says in an unresolved gold rush, selling pickaxes wins whichever river hits gold. That's the brilliance of the neutral positioning. You're in the growth either way. You don't need to be the one who picked right. But now the other pan of the scale, the trade-off, and the deck is honest. The cost of that safety is passivity. The deck says MSS growth explosiveness is entirely tethered to the speed of the gold rush, not to anything MSS does itself. In its own words, MSS is a steady participant, not the conductor of the timeline, and that's a real ceiling on the upside. I'll read, here's the trade in one breath. You buy safety and steadiness, and you give up control of when the payoff arrives. Alright, last slide, and this is the homework list. The deck calls it the tracker, the KPIs to watch over the upcoming quarters. First, MPTech proof. The deck wants explicit company updates confirming the debugging methods actually adapt to NP and VCSEL NPO structures. Second, equipment landing. That means confirmation of MSSHG sales in Q4 and a buyer base that's spreading out, not just one customer. Third, IP signatures. The deck is watching the licensing move from talk to finalized contracts with international equipment vendors. Ink on paper. Fourth, timeline consensus. The deck wants to see analysts finally converging on one definitive mass production year instead of all this guessing. And fifth, sentiment repair, tracking whether the stock can finally decouple from those sector-wide mispricing events we talked about earlier. Then the deck nails the punchline. The positioning is correct, but the execution over the next 4 quarters is what dictates the value. I'll read, that's the honest scorecard. The strategy looks smart on paper. Now we sit back and watch whether they actually deliver it. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.